Good morning, everyone, and a warm welcome to our live webinar today. Today's topic is around global dairy market fundamentals and price risk management. That's a bit of a lengthy title, isn't it? But I'll be hosting you today. My name is Lisa North, and I have the great pleasure of having our central portfolio management team with us today. Two of them are live with me in the studio here at Fanshawe Street, and Richard joining us from online as well. We are live, so do bear with us if we have any technical challenges. No doubt we will at some point, but we'll keep moving through those as quickly as we can. So great to have you on board today, so let's get started. So from an introduction point of view, I'll take you through our guest speakers today. We've got three of them. So a great team from the Central Portfolio Management Office within Fonterra joining us today, and they're the real experts when it comes to all things global dairy, supply, demand and price. They'll take us through a little bit of market fundamentals, which Richard will take us through. That'll give you a good sense of how we're seeing the market moving forward and the impacts around some of the, I guess, dynamics we're seeing in a very disrupted world at the moment as well. Then we'll go through a suite of price risk management tools, and this is probably the bit you're most interested in. So how do you manage kind of the volatility of the world at the moment, look a little bit for some different pricing options and have more optionalities when it comes to some of your procurement decisions. Then we'll pause at the end for some questions as well. And we do have a live chat open, as you can see on your screens. So please type your questions as we go through, and we'll pause throughout the sessions to make sure we answer those. So we've got a great range of speakers for you today, and I'm really thrilled to have such a broad team out of CPM joining us. In the room with me, we've got Kristen Ashby, who's here. She's our General Manager of Risk and Commercial Solutions, so she's really across all of the suite of price risk management tools we'll take you through today. And then on my left, we've got Karthik, who's also in our Risk and Commercial Solutions team. He'll be working with Kristen to take you through those options as well. And then joining us from his home office is Richard Lawn. Morning, Richard. How are you?
Yeah, good morning, Lisa, and hello, everyone.
So Richard's our GM of Commercial Intelligence. Richard's been in the business a long time, so he's really kind of our expert when it comes to all things global dairy dynamics. So great to have you along with us today, Richard. So just before we kick into the speakers part of the event, I just wanted to kind of frame up why we're here today. So a lot of you would have participated in our recent customer survey, which is our ARS survey, which comes out every year, which has recently been renamed from our CBM survey. And thank you so much for your participation. One of the key bits of feedback from all of you through that survey was really saying, an area we'd like to hear more from Fonterra is kind of around this whole, what's happening in the market, what are the more, I guess, recent market updates, what's the pricing kind of forward view of pricing that Fonterra has and can share, and some better solutions to really manage some of that volatility we're seeing. There's a lot of volatility in the world at the moment. Dairy's not immune to that. So, you know, how can you have a forward view and make some better decisions around some of that procurement that you're doing? And then how do we look at some different pricing options for you as well? So I'm hoping today's session will be both informative, but also start a conversation which we can pick up with you from today's webinar as well. And of course, underpinning all of that is security of supply. And we know with disruptions in supply chains at the moment, there's a lot of volatility and delays around moving product around the world. And New Zealand's not immune to that when we think about dairy as well. So let's get started. I'm going to pass over to Richard, who's going to take us through a few slides and talk a little bit around those global dairy dynamics at play. So over to you, Richard.
Kia ora, good morning and welcome. And yeah, thanks again for the opportunity to speak to you today. Today I'll be covering these two main areas. First of all, market volatility. So I'll look at why volatility is important, what factors drive it, and I guess also how we quantify it. And then I'll look at our market outlook or our fundamental view on price going forward. So let's kick into it. Why is volatility important? Well, we operate in dairy, and dairy is an agricultural commodity, and it's literally part of the game we're in. When we look at dairy and agriculture, we're really exposed to some key factors that keep volatility alive. When you look at cows, they're living animals, and so they're exposed to all the animal health and virus and foot and mouth aspects. We're also exposed to weather, so whether that's droughts or floods. And because we deal in food, we're also exposed to a number of geopolitical, I guess, constraints that could be protectionist in nature, such as tariffs or quotas. And then, of course, we're exposed to the general macroeconomic events. As you'll see at the moment, we've got sort of rising inflation and COVID ripping through the world. So all those factors contribute into the volatile nature of dairy products. And when we look at that in comparison to other commodities, you can see that we're right up there as one of the highest volatile commodities, and we have no reason to believe that will change. So volume times price equals revenue or return. And the risk or uncertainty of that return is a function of exposure times volatility. Now, given in most people's business, the volume that they're either purchasing or selling is largely fixed, it's really the volatility or the price change that is the big driver of risk and therefore risk to your returns. So it's really, really important that we manage this aspect. Now, although we are an island, we're part of a global market. If we go to the next slide, you'll see the total size of the dairy market is around 400 billion litres. But we don't have access to all of that market. Some of it's protected through trade, some of it's just domestically consumed in local production. But we are exposed to the traded portion, which is around 70 billion litres. And within that market, we're actually a large player, with New Zealand producing 20 billion. It's a big proportion of that traded exposure. But what it does mean is small changes in that global market that flow through into the traded market can have an outsized impact. And because New Zealand is actually exposed to that market more than its competitors, for instance, 95% of our product is exported versus about 20% for EU and only 10% for the US, we're exposed more to that change. And to give you an example, if we were to look at a 1% increase in milk production, if that would all flow into the traded market, a 1% increase in New Zealand's milk production only has a 0.38% increase in global exports. But a 1% increase in Europe's milk production flowing through into that market is 2.6. And that relativity or scale is 7 times the impact of New Zealand. So that's just an example of how that leveraged impact really plays into volatility, both up and down. But just small changes or small differences in expectations can really flow through into pricing. Now, there are, I guess, I'll just give one example, but there are a multitude of factors influencing supply and demand. And indeed, we could model to the depths of the world on all the different factors. But to give you an example, we do go pretty deep. So for milk, we look at country, state, cow numbers, culling rates, productivity, feed prices, temperature, weather. But in the end, you still have to make some assumptions, and you still need, I guess, ability to distill all this into a view, and I guess particularly a view on price. And the tool we use to do this is the supply and demand framework. Now, this is, I guess, a relatively simple maths, and it works by identifying imbalances in the market and then how these can be resolved through price. And it basically works on stock levels. So we're trying to model stock and then apply the normal supply and demand dynamics. So if we see stocks high, in order to resolve that, price would have to come down. And similarly, if we see stocks low, in order to resolve that imbalance, prices would have to go higher. And that's really what we're looking to do when we distill this down. And I guess it's important that this process doesn't remove volatility. What it allows us to do is to take a view on what way that volatility will inform price. And of course, the only way to take a benefit from that is to then improve your decision making on contracting, pricing, and your sales tactics. So when we now look at, I guess, our fundamental view or outlook, we'll kick off with global milk supply. And I guess overall, this is now tracking quite tight. So we had seen, I guess, or had expected feed prices to come up, and for the US, which have been tracking at quite high monthly growth rates of around 3% earlier in the year, to start to slow down. But over the last 3 months, we've seen that rapidly slow. And then I guess coupled to that, the sort of, I guess, surprising decrease also in Oceania, we've now moved from, I guess, a really kind of balanced growth to now below average growth. So that's really, I guess, putting quite a lot of supply side tension in the trade and the supply and demand dynamic. If we look at New Zealand milk collection itself, yeah, I guess this has sort of come to a surprise to us, coming off quite a high milk price, and I guess an even higher forecast for this season. We're expecting farmers to sort of, really push their cows hard. That hasn't happened to the degree we thought, and I guess the weather also hasn't played ball. And so, as you can see there, we've been tracking down around 4% through August and September. That's been published, and I guess we've got concerns as we go through past peak that we may not be able to recover that. There's still time to recover, and we may get a push in through the shoulder like we did last year. But again, this has certainly been a surprise to the market, and I guess puts further upside pressure to pricing. Now, when we look at whole milk powder itself, and I guess when I saw the timing of this meeting, this is now post GDT, but I can tell you this was written well before. We are expecting prices to sort of stay around current elevated levels. But that's not to say things aren't changing. On the supply side, we're actually seeing supply pullback, and that's largely been driven by a reduction in production from New Zealand. We haven't seen any material change from the EU. They're focusing on other products. And in Argentina, who has got some milk growth, the growth in whole milk powder has been relatively modest. So overall, it's sort of a lower supply. And on the demand side, it's really the high current prices that we expect to start to burn off some demand, particularly in MEA and SEA, but also given the sort of record imports from China last year, to think we could grow on those comparables, it's going to get more and more challenging. So with, I guess, lower supply and lower demand, we still see a relatively balanced position. And you can't see very well in the stocks price, but sort of you can see all those lines are sort of in the middle of the pack, which sort of says we think things are pretty much in check at the moment. However, when we move to skim milk powder, the story is quite different. And there in I guess our stocks chart, you can see our production is for very, very low stocks. Now, that's not to say that will happen, but back to our S&D framework, what that tells us is there's an imbalance in the market, and therefore, basically, we expect pressure on price to resolve that imbalance. Now, part of the story here is we are seeing actually increasing production in skim and relatively flat demand, but I guess a big part of the supply or availability that had been in the market had come from EU intervention stocks, which are government stocks that had been sort of drip fed back into the market. That's now long gone. And so even with sort of flat demand without that availability, we're seeing that shortfall flow through and putting pressure on price. Yeah, onto butter. So butter is a much more fragmented market, and there's a couple of reasons for that. I guess the US really doesn't export to any extent, and it's got quite large stocks domestically. And that's really, I guess, making their pricing lower than the rest of the world. And you can see there the orange line in that pricing chart, and they're tracking below both Oceania and European prices. However, saying that, the post-COVID, their demand recovery for butter is improving. So we expect some of that to sort of tighten, subject to COVID remaining in check in that market. For the Europe and New Zealand, it's actually pretty balanced and relatively supported. And I guess particularly for New Zealand, with the tariffs coming off 1st of January into China, we actually see probably more we'll get more of a kick from China as we get into that period. And they're really driving the market. So in terms of price, we sort of expect New Zealand to remain above the US and in line, if not above, European pricing. Yeah, so just to recap, I guess, dairy is volatile. That's sort of the nature of the business we're in. Certainly the structure of the market can help amplify some of that volatility. And I sort of talked through our S&D framework for how we sort of quantify that and use it to form an outlook. And sort of based on that methodology, outlook is tightening milk supply. We see whole milk powder relatively balanced, so keeping sort of at elevated prices in the near term. On the skim milk side, we see actually supply quite tight, and therefore putting upward pressure on price. And I guess in butter, as we just sort of covered, it's sort of more fragmented with USA tracking below the rest of the world, but might start to improve if the demand past COVID improves. And that New Zealand will continue to have pretty good support from China, given the great demand from there and the lower tariff into the market.
Thanks so much, Richard. I love the way you took all that complexity and made it sound so simple. It's always so interesting to look at all the dynamics at play when it comes to how we manage through price and risk. And certainly our second half of our season is going to be an interesting one. I've got a couple of questions for you that have come through on the chat, if I could. First one is a little bit of a clarifying question. So when you've talked about a demand and supply picture, is that just Fonterra's or is that the total global picture that you've been talking about?
Yeah, no, good question. No, from a fundamental point of view, we always look at total demand. So we're looking at total whole milk powder supply and demand throughout the world, and particularly the key origins who play in that sort of traded market that we talked about.
Okay, thank you. And then the second one related to China, quite a hot topic after last night's GDT event. So if China is buying less on GDT in recent months, why is the whole milk powder price still going up?
Yeah, so a good question. And I guess there's a couple of answers to that. Is that the rest of the world is also demanding our product, which is good. And as I talked about, nobody else is really supplying any or coming to the party to resolve the supply side imbalance. So it's really just New Zealand's is I guess the best and only option if you need to buy whole milk powder. On China itself, I guess it is a difficult market to get a read on it. It's very opaque. Now we see our current customers have, I guess, for supply chain reasons and others, been trying to purchase ahead of what they need, and so it's sort of taking a bit of a pause at current pricing kind of makes logical sense. They've sort of got that time and ability to sort of work a bit more stock through, and so then I guess we're still expecting them to come back a bit later in the year.
Okay. Good. And then last question in the chat for you is around skim milk powder, and again a bit of a clarifying question. What are intervention stocks?
Yeah, so in Europe, the government, I guess, runs a subsidy program to support farmer payouts and prices, and they do that by purchasing their products, particularly skim and butter. And so it basically sets a market floor or ceiling price for skim. So when the European skim price fell below that level, the government started stockpiling because they became the purchaser. They've got no use for it, so they was basically filling their caves. That got up to around 300,000 tonnes, I think, at the peak. And so that sort of then weighs on the market, but as demand picks up, they've been drip feeding that back out. And that's now all been consumed. And so I guess without that sort of being now fed back into the market, that's now providing a shortfall in supply.
Interesting. Good reminder of the regulatory environment in which dairy operates as well, right? It's a fascinating one.
Absolutely challenging, and it's constantly changing.
Be all eyes glued to CNN most mornings then.
Yeah.
Awesome. Thanks so much, Richard. Really appreciate that. It was a great overview, and thanks for answering some of the questions as well.
No problem.
So let's move on then. So now we wanted to talk a little bit around some of our price risk management tools. So now we've had a little bit of an overview of where the dairy dynamics are, I guess the balance of supply and demand. Now we wanted to take you through a little bit of an overview of some of the options around how to manage some of that volatility, particularly when you're looking forward to both secure supply and maybe understand the pricing at play as well. So Kristen and Karthik are going to take us through a little bit of an overview around what price risk management is, and then take you through some examples of the tools that we have on offer. So I'll pass over to you guys.
Thanks, Lisa, for the intro, and thanks, Richard. I guess if you didn't already know how volatile dairy markets are, now you do. Might even be feeling a bit uncomfortable. So Karthik and I are in what we call the Risk and Commercial Solutions team. But what that really means is we run a little bit of a bank inside Fonterra. So much like you may choose to fix your mortgage interest rate on your house or leave it floating, our team works with customers who buy Fonterra dairy products to also manage the risk of price on those products. So, for example, customers can choose to lock in the supply of what they need and the price on all or a portion of their purchases using the tools that we sell. And we'll take you through those tools today. Some of these tools are a little bit complex, and so I would really encourage you to ask questions if you have any. No questions are bad questions, so keep them in the chat, and I'm really happy to lift your education in this area.
Sounds good.
No, this the global volatility can have a significant impact on your performance and your budget and the way you can plan for this as well. If you look at butter just last year, in a 6-month period, the prices went up by 75%. So this often leads to a situation where you aren't able to purchase the volume that you need or at a price point that you can't actually control. So how can we help you manage this? So we have 5 solutions that allow our customers to lock in supply and increase their price certainty. Each of these tools offer a different level of protection and also customization. Due to time constraints, we will not be able to go through price break or the double cap collar solution, and I would encourage you to get in touch with the account manager if you want to go through this. So the first solution we will discuss is the price index solution. This allows our customers to lock in supply using a market reference with an agreed adjustment. An example of a market index is something like GDT. The second solution is the price lock, also known as a long fixed price, which is a solution you can use when you want absolute certainty of the price that you will pay. And finally, we will discuss price collar, where you're able to lock in supply while retaining some flexibility on the pricing range.
Thanks, Karthik. So first up, I'll explain the price index, which is one of our most commonly used tools. So the chart on the right-hand side there shows you how a price index works. And essentially it is a good way to lock in your supply, but to ensure that your pricing is aligned with market movements each month. So customers who want to stay very close to the market at all times, or perhaps have a view that prices will fall and want to take advantage of that, really like this option. So first you choose your price index, and as Karthik mentioned, that could be GDT, but we do use other indices, for example, the CME, Chicago Mercantile Exchange, and there are various other indexes. At that time, you get to fix your supply. So another benefit of these tools is that you have a supply certainty, and that means that each month you know how much you're going to get. And you also choose the period of time for which you'd like to lock in this agreement linked to the index. Typically we go up to 18 months, but we can go shorter or longer, so it just depends on what your business needs are. So I'll give you a little example of how this might work. We have a customer who's a food manufacturer and they need to buy butter. And they would like to really improve the price transparency for the butter that they purchase. At the same time, they want to make sure they've got secure supply because they don't want to run out of butter. And they also want to retain the flexibility to purchase more butter if they need it. So we would go to the customer and discuss a number of different options. And in the end, the customer decides that the price index with a complete transparency of price is best for them. And they'd like to lock in 50 metric tonne a month of butter. Now that's half their forecast needs. So they've still got the option to purchase the other half as they need it based on the spot market, which is probably the way they purchase today from Lisa's team of account managers. Mm-hmm. Now the price on this under this agreement is linked to GDT. So when the auction runs every second week, they can see what GDT settled at, and they have a good view of what that's going to be priced at, and then they can discuss with their account manager how the calculation works for the month, and the price is as per the calculation. So complete transparency of that. And the other benefit of this tool is that once you've got your market linked price and you've got your volume secured, you can still add the other tools, which Karthik is going to take you through shortly. So it doesn't lock you into this necessarily for the duration, but your supply is linked. Sorry, your supply is locked and your price is linked for unless you want to upgrade, I suppose. Cool. So the chart there shows the GDT price at the bottom here, the grey line. And then there's an agreed adjustment, which you would discuss with your account manager on top of that. And that would cover things like freight, storage, additional costs of a specific specification material that you might need for your business. Fractionated butter, for example, could be an example of that. And this particular customer wants to do this agreement 50 tonne a month for 9 months, but that could be longer. Linking through to the GDT unsalted butter contract period 2 price, and the customer can see that result every time we have a GDT event. And just a reminder, as a customer, you still have the flexibility to add additional volumes on top of this to meet your demand requirements as you go. So that was butter, and AMF is done in the same way, linked to GDT. We also do this commonly on whole milk powder and skim milk powder. And there you can see on the chart on the right, we've got whole milk powder at the top, skim milk powder at the bottom. They're both very volatile. But if you are a customer who wants to stay close to that market at all times, for competitive reasons or for your own business purposes, then you would want to stay close to that, and we can do an index linked to GDT for both of those two products. Protein is slightly different. So the proteins I've got here today are MPC, so milk protein concentrate, and WPC, whey protein concentrate. They are also quite volatile, as you can see on the right, particularly not great in the last 6 months if you're purchasing. So these ones we base usually on skim milk powder and the protein component of what you're buying. So if it's MPC 56, MPC 70, MPC 85, as the protein component goes up, the multiplier also goes up against the skim. So as the customer, if you're buying MPC 85, you would have, GDT skim milk powder times the multiplier to get to that protein percentage, again, plus your agreed adjustment, and you would have transparency as skim settles on GDT, what your MPC price would be. WPC is reference to a Dairy Australia WPC 80 price, and that's an Oceania index to which Fonterra contributes, so like a survey price. And this one's a little bit harder because we don't trade this one, but we do have customers with market index linked to WPC.
So, any questions?
Yeah, thanks, Kristen. So a couple of questions, one for you and then one maybe for Richard. First one is, can I change the volume on a price index supply agreement after it is signed?
Yeah, good question. So the short answer to that is no, you can't change your volume. And the reason is that you as the customer, when we enter into this agreement, gets complete certainty of volume, and that will not change. And likewise, Fonterra gets certainty of demand, which is also a benefit for us. So at the time, you're locking in a volume and we're locking in your demand. So that should match up. And that's why we usually recommend to customers to not do 100% of their portfolio in one hit. You might do up to sort of 70 or 80%, and that gives you your demand flexibility to add more as you need it.
Nice, thanks, Kristen. This one might be for you, Richard. So Brian in the chat has asked, what other potential markets for dairy that New Zealand is developing to reduce over-reliance on China or to China?
Yeah, that's a very topical question. Yeah, I guess the way we look at it is actually Fonterra is already quite diverse. So we've only got we've got 3 regions, and we've got about a third going to China. So we don't see ourselves as overly reliant on China, as I guess some of the other political commentators do. And I guess the other answer to that is, we're in business to service our customers, and China's a very valuable part of that business community. And often are prepared to pay the best price. So it does make a lot of economic sense for us to support and continue to grow that market.
Yeah, It does make sense, yeah. So again, I guess just to reiterate, from a global perspective, we really have three key regions: EMENA, which is covering, I guess, the Americas, Middle East, Africa region; APAC, which is where I sit, which is Asia Pacific and a fast-growing region; and then obviously China sits as well, reporting into our CEO, the three big regional heads. So very much a third, but yeah, China often is the hot topic of conversation, as Richard said. Okay, so that's all for the questions, so we'll keep going.
Thanks, Lisa. So why is this volatility a problem? Generally speaking, the retail prices are quite stable. And if the dairy input costs shift significantly, there is the risk of margin reduction and, under some extreme cases, negative margin. So price lock, which is our second solution, is something that you can use to reduce this risk. When we talk about price lock, it allows our customers to completely avoid market volatility by agreeing a fixed price for a time period. You have absolute certainty of supply for this period and what you're going to pay. We typically offer this solution for up to 18 months, but depending on your business, by exception and product, we can go longer. If we work through an example, if you're a powder customer looking to increase your price certainty for your purchases of skim milk powder, to allow for more accurate forecasting of your future earnings as well, you come through to us in March and we come to an agreement to supply skim milk powder for an 11-month period starting in June at a fixed price of $31.50. You've chosen to lock in only 50% of your forecasted needs to make sure that you retain some flexibility to purchase additional skim milk powder at the market price and to allow for any demand changes, while also considering the current market prices. So the price lock solution has allowed our customers to better manage their P&L and budget, plan their advertising and promotion spend without the uncertainty of unexpected cost increases or supply shortages.
So this is the fix your mortgage option, isn't it?
It is your fix your mortgage option. It's great when you don't want to worry about the market movement and you just fix and lock away.
Yeah, right.
You just worry about running your business from then onwards.
Keeps it simple, right?
It does keep it simple.
Any questions on that?
Just checking the chat box. My computer seems to have decided it's going to go slow, of course. Let's keep going and I'll come back to you if I have any chats.
Sure, no problems. And the final solution that we have is the price collar solution. So price collar gives you the certainty of fixing your supply while retaining some price flexibility within an acceptable range. Now, you would choose your price range, which is a cap, the highest price that you'd pay, and a floor, the lowest price, and you would float between with a agreed market reference, such as UDT. So on the graph on the right, you can see if you have the green, which is the price changing daily, we agree to lock in the floor and the cap, and even if the market moves beyond it, you would be fixing the floor and fixing the cap. Typically, again, we offer this for up to 18 months, but can discuss longer if required.
So Karthik, maybe if we just pause here, I do have a quick question in the Q&A. Someone's asked, what is the difference between price lock and a fixed price offer for 3 months that I have had before?
There isn't a difference. It's exactly the same. Price lock is the term that we use for a longer term fixed price.
Okay, so in effect, a lot of the people on the call today will be quite familiar with this. It's just more the understanding of the mechanism behind it, I guess, is what we're saying today.
Yes,
yeah,
correct.
Perfect.
And I suppose the one small difference is that a fixed price for 3 months, we can actually offer a fixed price for up to 18 months.
Exactly.
So if you like the price
Yeah.
and you want to keep it for longer, then instead of going 3 months at a time, you could go further than that, even if it's on a portion.
Portion of your volume, yeah.
So we're really saying anywhere between 3 and 18 months. This is a good option to consider from a locking in perspective.
Yeah, and we also have customers who haven't done this before that like to do a little bit of volume as a trial. So they might do 5 or 10% or just a little bit of something to just see how it goes with their budget and their cost of goods sold average price. And then if they find they have a good result, they would evaluate that and maybe add a bit more. They also might look to add 10% a month. So they might do
Build as they
10%.
go.
Yeah, build
Yeah.
a hedging
Yeah,
profile.
nice.
And if you're already doing risk management on foreign exchange or interest rates, this fits quite nicely into those sorts of policies.
That's a good point, because you basically get exposure for different months. You're not kind of
Locked to one point.
locked to one point, and the GDP goes up and you have to purchase. You're just kind of building that exposure as the months come by.
That's right.
Yeah, which makes a lot of sense when we look back at Richard's volatility graphs, right?
Exactly. I think the term that many of our customers use is layering in prices. You just kind of get more certainty as you come in. So just finally going through an example of what a price collar could look like. So if, again, a customer is looking to increase their price certainty while retaining some flexibility for their purchase or schedule partner. Now, they basically want to get additional certainty for setting their budget, while also participating or getting the benefit if the market prices fell. So after discussion with the customer, we offered them a NZMP price collar in March for a 4-month period starting in September. We set the cap at 33.50, which works for their budget, and a floor of 3,000, which is the maximum price and the minimum price that this customer would pay. By using this solution, the customer has the benefit of any downward market movement if they see this, so they can leverage their market insight, and if that's a key risk that they see, they can take that benefit. So yeah, that's the second tool that we have.
Nice. So there's a couple more questions in here. The first one, can the floor be lower than the current price?
Yes, it can. We'd like to set the range of the floor and the cap where the market could go to, and definitely below the current market price as a position.
Okay. The nice thing about these tools, and they apply to other markets as well, is they're fully customizable. So we can put the cap and the floor wherever the customer wants, if they want a smaller range or a bigger range. And then depending on what that results in, it could have a premium to pay, or it could be a zero cost collar. So most customers prefer a zero cost collar, and we usually try and at least offer a couple of options in that space. But then if they want to change their ranges around, we can price up essentially a premium, which keeps it in the range that they're happy with.
Yeah, nice.
So yeah, usually when the customers come through us, we give them a range of collars and caps, and they can pick and choose, right? So they like to see them all, and then say, actually, this works for us.
So it kind of comes back to that suite of options with the 5 different areas we talked about at the start, sort of playing around the different areas and figuring out what works best.
Yeah, that's right.
Nice. This is a little bit of a question around dairy versus plant-based or non-dairy. So thanks, Brian, for your question. So Brian's asked, the demand for dairy products in the US is considered lowest ever due to lactose intolerance and rise of non-dairy plant milk. Will New Zealand increase export to more potential growth products that suit lactose intolerance, such as cheese and lactose-free milk products? So it's really around lactose intolerance and cheese and lactose-free milk products. Richard, I'm not sure if that's in your sphere of thinking. Certainly from a non-dairy perspective, I guess as a cooperative, our farmers would like us to continue to export the value of New Zealand milk, and that will always be core to our cooperative. And where there may be some complementary solutions from a plant-based point of view, we may look at those, but certainly dairy and our cooperative model continue to be our core focus in our business moving forward with our strategy. Don't know if you had anything else to add on that one.
Yeah, no, very much aligned with that response. And you're right, customers do see those products as complementary and often interchanged between them. I guess from our position itself, we see our supply base as relatively constrained and demand continuing to grow. So we see plenty of opportunity out there in the market.
Yeah, I think certainly our brands business would be exploring areas around lactose, low lactose or lactose-free options as well from a consumer offering. Okay, good, thanks.
Perfect. Yeah, and just to kind of recap the benefits. So NZMP offers both physical and financial solutions. It gives you confidence to meet your budget forecast by getting you greater cost certainty. You can balance your supply flexibility and supply security needs by purchasing either 50% of your volume now and looking to market the rest of it. You can better focus on your strategic and value add priorities and remove the distractions of following the market and understanding the market news. And you have the simplicity of working with a single partner for your ingredients, price, and supply needs.
Nice. So we've got a few more questions coming in now, hot and fast on the Q&A.
Yeah.
So Ruhan has asked, hi, is there a minimum volume or time requirement for price lock?
No.
No, Ruhan, there is not.
Just a maximum that we always have a standard pricing offer ready for 8 months.
Yes.
If people want to go 3 years, we actually do that. It just takes us a little bit more time to work out how that might look, because we don't know what the milk price is going to be in 3 years. So
so kind of 18 months is probably about right from a volume or time perspective.
But small business, very small businesses can still use a price lock, because it's not connected necessarily to that whole container, needs to be on the lock. Gotcha. A portion of that. So
okay, good. Second question is, can you fix supply and price over a period like 200 metric tons over 6 months, or does it have to be a per month basis? So I guess they're saying, could I contract 200 metric tons for 6 months, but not specify the monthly offtake in amongst that 6 months?
Unfortunately not. So we do require the monthly buckets. And the reason is that Fonterra, essentially by selling a fixed price, sort of brings in risk from your portfolio into our portfolio. And then we actually use the NZX futures, which is a publicly traded index not owned by Fonterra, to offset that risk. So we offer you a hedging option, and then we have to then hedge it ourselves. And so essentially what this price risk management is a service that sits in the middle and helps you achieve that. So that's why we need it in monthly buckets, because we need to then manage the risk on the other side. Hopefully that makes sense. Let us know if that doesn't make sense.
Okay, good. Hopefully that answered the question. And then another question around price collar. Is there a minimum volume we need to commit to in metric tons per month? And also, what drives the cap and floor you set? Is it driven by internal Fonterra price forecasts? So long question in 2 parts, really. So first one was around volume commitment in metric tons per month for the price collar, and what is the commitment we need to do for that?
So with regards to volume commitment, it's similar to the price lock solution, where we do manage the exposures on the back of it. So though there isn't minimum volume commitments, we do need it to be in that monthly bucket. How the cap and collar, it really is regarding the volatility of the market. It's not an internal measure. We use something known as the Black-Scholes equation, which is a financial term, and we bring in all the market factors, where the prices are and the volatility of that market, which tells us what the cost of that cap or floor is going to be. So it's not an internal Fonterra measure or a forecasting perspective. It's simply a financial equation.
It's probably a little bit like I'm going to get the wrong word here, but in an insurance company, you know, if you're an 18-year-old male driver, your insurance premiums are significantly higher because you're high risk. And if you're a 65-year-old or over, they're significantly lower. So the Black-Scholes model is commonly used for valuing risk in financial markets, and that is what is applied for the collar, in the same way that a insurance company would work out your risk and therefore the price. So in a less volatile market, say if we said whole milk powder, as a relative scale, the collar could be closer together without a premium, but in butter you'll find that a little bit harder because the market tends to be quite volatile, and we do some standard kind of modelling around that. And that's why we like to give customers lots of options: a zero cost collar with a wide and a narrow, and then some different options that meet your budget requirements perhaps. So yeah, happy to run lots of those scenarios to meet your needs as required.
Nice, thank you. All right, I think that's all the questions answered for now. Let's keep going.
Great, well, thanks everyone. We're coming towards the end of our presentation. So again, if you have more questions, pop them in while we're still here. But in summary, we have 5 tools to help you manage price risk. And what we've gone through today is the price lock, which is your fixed mortgage, your price index, which is your floating mortgage, and your price collar, which is your mortgage somewhere in between 2 specific points. And what the the matrix here is showing is that they apply across pretty much all of our products. So we can do them fairly on all of them on whole milk powder, skim, and the fats, butter and AMF. And we can do most things across our protein portfolio. And if it's not on this chart, we have lots of bespoke options that we do for customers regularly. They just take us a little bit more time and we need to work through them. So really, I guess our goal is to find something that works for you in your business. And that can include analysis, historical pricing, scenarios, insights like as Richard has just shared, or sharing how other businesses might do PRM. So, you know, we sell these around the world, and we're happy to take you through other examples of how other businesses might do this for some ideas. So yeah, we're interested to talk to you further about price risk management, and we will plan to do this in our next sort of communications with you. But in the meantime, if you do have questions, please feel free to reach out to your account manager and we'll support those conversations.
Awesome, thank you. So one last question has just popped through. So if we are a customer with reliable monthly volumes, would Fonterra assess us as, and then there's no further. So I'm not sure what you're asking us to assess us as, but absolutely, if you're interested in buying from us, if you aren't already, and you've got some monthly volumes you'd like to discuss with us, we'd love to hear from you. So reach out and contact us either through nzmp.com or through your account manager, and we would love to pick that chat up with you and see what we can do. So that comes to the end of the presentation. We got through without any technical glitches, I think, which was nice. And thanks so much for all of you for joining us today. I hope you found that interesting, stimulated some thinking and some ideas on your side. It's really just the start of the conversation, as Kristen said. We would love to hear from you if we can pick this up with you off the back of the webinar. My account management team has Catholic and Kristen alongside us. We are happy to help, and we will love to hear from you and see if it was useful and if there's something that you'd like to pick up and discuss a bit further around amongst that 5 options that we talked about, or perhaps talk a little bit more around some of the other options we have. So we would love to hear from you. There is more information also on our website, nzmp.com, has everything you need if you wanted to do a little bit of more digging around and research, or contact us directly. And from my side, thanks so much again for joining us today. We're all leading busy lives, so appreciate your time, and hopefully you found it useful. We will send out a copy of the presentation that we took you through today, and also a link of the recording so you can re-listen to it at your leisure. So have a great day, stay well everyone, and thanks again. And thanks Richard, thanks Kristen, and thanks Catholic.
Thank you.
Thanks everyone, bye.
Bye.